Hello, everyone. Welcome to this week's Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. So, this week I wanted to address gold prices. It's something I've been talking about a lot. Talked about a lot last year because it was reaching record high. And yesterday on the 26th, it broke 5,000 and $5,000 per ounce. And what's interesting is, to a certain extent, silver has been reaching record highs as well, though today has been selling off. But to a certain extent, these seem to be the only places, the only commodities or asset classes that are really absorbing macroeconomic risk. And this is why I've always paid attention to gold prices. I don't really buy gold, I don't really buy silver, but I pay attention to these markets along with a handful of other variables because I think there's a lot of important risk information that gets embedded into gold and silver prices. Now, what's interesting here is that when we look at some of these other variables, when we look at the 10-year bond yield, which is yielding about 4.2% roughly. We look at the dollar index, which is down. The dollar index. This is a index of the dollar against a basket of other major currencies. So this shows you that the dollar is down. Inflation is still running north of the Fed's 2% target. And then we have these big headline risks that have been coming out. The administration is still trying to politicize the Fed, which is a really bad idea. I talked about that last week, kind of in depth. And I wrote a blog post too on our website, fundamentalinvestinginstitute.com. Went into a lot of depth about that. And basically went into the history of the Federal Reserve and the White House and that relationship and what that relationship has looked like, and basically just trying to argue for why politicizing the Fed this explicitly is really a bad idea. So certainly you have that. You have just general geopolitical risk, and anyone watching the news sees a lot of that. And I think gold and silver prices are the only places I can see that are kind of absorbing that. I really don't see equity prices at levels that would factor in these potential risks. I certainly don't see it in the 10-year bond yield. So one of the things that's really interesting is whether gold and silver can continue to bear the weight of these different risks that we've talked about. And the other thing to consider is whether higher gold prices is going to lead to more gold supply coming online. So we're starting to see articles like the one I have in front of me here. This is from the Wall Street Journal. It says gold boom has miners scrambling to find the next mother lode. So basically, because gold is a commodity like any other, it costs a certain amount to take gold out of the ground to mine it. And it's the same thing with oil prices. When you have very high oil prices, it creates a lot of incentive to bring new supply online. And in the case of gold, that gold costs a certain amount to mine, and if prices are high as they have been, it's creating a lot of incentive for miners to find new supply. And in this case, you have mines in South Africa and other places in the world that were not economical before this big spike in gold prices. Now they are economical. So you have this big surge that's going to happen probably over the next few years, where more supply is going to come online. And that's something that anyone who is coming into this needs to consider. Now, when I look at gold and silver prices, I really see two basic factors. And arguably, this is the case with any asset price. The first is whether you have legitimate factors that are driving this. And as I said, the geopolitical risk, the risk of potential domestic inflation, and whether there's a rotation out of the dollar. Those are certainly legitimate risks. I don't know what the proper price would be in gold and silver prices, but that's certainly part of it. One thing you saw last year is global central banks started to really rotate out of the dollar and increase their gold holdings. But then later in the year, you started to see gold was being driven more by retail investors through ETFs and other instruments. So that's the second part of gold prices is it's kind of a momentum trade. You have people who are just buying gold because they've seen it go up and they think it's going to continue to go up. So it's sort of momentum begets momentum. And it's hard to understand how much weight should be given to each force. So my point is, I think at some point, either A, some of these risks dissipate, in which case you're going to see a pullback of gold and silver prices, or some other aspects of the economy are going to sort of pick up some of the load in pricing in this uncertainty. There's certainly other macroeconomic risk. I'd say the big one right now, in addition to the ones that I mentioned, is probably a lot of the debt associated with AI data centers going into the bond market. And things are getting a little jittery there. I know some very smart people who are thinking that could be the next debt blow up. But it's certainly a systemic risk that all investors should pay attention to. So, the world is always uncertain. There's always uncertainty, but there are certainly risks that are being kind of absorbed through gold and silver prices. That's less the case with other commodities. Gold and silver, just because they have such a long history of being seen as an alternative source of value. So in a world in which people lose faith in fiat currencies being those currencies that have nothing backing them other than the full faith and credit of the issuing government, gold and silver are viewed as an alternative source of value. And that's certainly one of the things that's driving them. But if I own gold right now, one thing I would be nervous about is, and silver as well, I would be nervous about the fact that you have new supply that's going to be coming online in the next few years, and that risk is probably not being priced in. So it's just something for anyone who's looking to get in on the gold and silver trade to think about. Moving on, like I said, we wrote last week, we posted a long form essay on our website, fundamentalinvestinginstitute.com, talking about the Fed independence, why it matters, and there's a lot of historical detail there, and I think it's a very good essay, so you guys can check that out. I also want to talk a little bit about what we're working on now. I have a series going out, a beginner's guide to stock investing. That's going to be coming out very in-depth. That's going to be coming out in phases over the next few weeks. And then I'm still working on a post series looking at Warren Buffett's career and the lessons from his career. And that's going to be coming out. Another part of that is going to be coming out this week. So we're going to be doing 2 posts a week for certainly the near future. I had a little side project where I was doing a series of Substack essays because I was doing a lot of reading on the global economy, and I'm probably pulling back on that a little bit. I hope everyone has a good week, and as always, focus on the fundamentals.